Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So you'll notice that we had our EIA show, but we didn't do the econ show this week. There wasn't a whole lot to speak about up until when we normally film. And then obviously we have the inflation data, we have that. So we're gonna pick that back up next week when we have a bit more to discuss and a bit more to go through. But in today's show, we're gonna look at the frac spread the frac spread count. We're gonna look at the rig count, what's happening with Russia, and then really start to touch on what is happening with both inflation as well as wages, because it's going to be important to look at where are things going to go over the next few weeks and really through the rest of the year based on what we're seeing so far. So with that being said, we have our frac spread count, which came in plus 11. So we went from 264 to 275. So if you remember last year, we thought that the peak was going to be 275. We came in right at 274. So we're now above where we were in 2021, which isn't surprising. For those that have been following the show, following the insights, we've been assuming that we were going to get to 275 either by it was the end of January, beginning of February, depending on how quickly some of the activity snapped back. And clearly, as of February 11th, you get an idea that we're right on the front end of February. So the activity was really driven, not surprisingly, by the Permian. We expect the Permian to be over 150 spreads really by the end of this month. So it's not surprising to see a bounce there. And then we also had an increase in the Uinta, in the Western Gulf, as well as the Williston. So we expect to see a lot of this continue. And we're going to go through why we expect that, especially as you see WTI prices at 93 under some fears and commentary around Ukraine and Russia, which we'll talk about in a minute. So as we see a lot of this activity increasing, again, it just puts our confidence on our target of that 12.2 to 12.3 million barrel a day production, but it has to come with a DUC increase. We have to see rigs increasing, we have to see drilled but uncompleted wells, because you have all these crews, you need to give them something to do. And as we've been talking about, we expect to continue to see rig activations. And here we had an increase in 19 horizontal, 4 vertical, and a drop in 1 directional. So when you just look at where the activity is, net for the total for the U.S., we had an increase of 22, all of them obviously on land. So you're seeing this big increase, 19 in oil, with a large part of that coming in Texas, coming back to the point of we're going to see, obviously spreads are going to take a pause here. There's only so much that we can add because, as we've been highlighting in our insights and on our shows, especially the econ show, wages, labor, all of these components will be constraints, which is why when you hear what the E&Ps have to say on their earnings calls, that you have CapEx going up, because a lot of these costs, especially diesel, as we cover on the EIA show, approaching $4 national average. You have labor, you have diesel. A lot of these things are going to be pass-through costs that have to be increased. And while some of the supply chains have improved, there's still bottlenecks, there's still issues. So yes, there's going to be some of those delays that will also remain in the system. Now, when we talk about Urals and we talk about the U.S. and Russia and Ukraine, this just looks at the amount of Russia crude oil and petroleum products that comes into the U.S. So over the through 2022 so far, we've seen an increase in flows, especially from diesel, coming into pad 1. So when you look at just where are some of these barrels going to be replaced, this becomes an ongoing situation. When you look at, if we sanction Russia, we've already sanctioned Venezuela, we've already sanctioned Iran, now we're going to sanction Russia. So it's going to become an issue because there's a quality problem. There's a certain amount of heavy sours that need to be consumed, especially on the heavy side, based on some of these different backdrops. Now, as we've been talking about, Urals have gone pretty much no bid in terms of just fears around this. So the most recent offer out there is minus $5.20 dated Brent. It's the widest I've seen. I mean, this is going back as far as 2011, according to the reports that we have. But this is something that I've been doing this since about 2006, and it's the widest I've ever seen. And the reason why I say that is because what we see on the screens is $5.20, and we're hearing that it's as low as below $7. So we do expect some people to start to come in and pick this up just because of fear of inflation. The fear of sanctions, about a potential invasion, and obviously the steep backwardation is always going to make it a bit more difficult. So here, when we start looking at who's going to start buying it, China is a very likely buyer, obviously. And you might think, why is this happening right now? Well, pretty much every country at this point has requested their citizens to leave the Ukraine. There's been conflicting reports back and forth in terms of, the U.S. believes Putin has decided to invade the Ukraine, expect invasion to begin next week, and now they're coming back and saying that we don't think that they're going to invade right away. So again, there's this push and pull in terms of where these views are. But obviously, you can see that there's a lot of tension, there's a lot of uncertainty, and that obviously hit the market quickly. We had the 10-year that was about 2.05%. That quickly went below 2% again. So again, we're seeing a lot of these movements in terms of where some of these fears are. We continue to think that rates will trend higher. The 10-year will stay above 2%. And again, we've already outlined how we think Russia is going to proceed, and we don't think a full-scale invasion is in the cards. That everything changes when, in order to go to war, you have to throw logic to the wind, and it's not like we haven't seen it before. So these are just things to watch. Obviously going to be a huge mover. If something happens, apparently Biden is going to be speaking with Putin by phone. Who knows what that's going to do, and if we can find some sort of political solution and middle ground. But while this is all playing out, we're going to continue to see this broad shift in terms of where these movements are. Urals will essentially, they'll be trying to give them away at this point. The backdrop is continuing to open up. There's still been a very slow movement out of West Africa. As this progresses, we expect that to accelerate. Angola has seen a slowdown in buying. We do think that'll pick back up as we now are fully into the end of Lunar New Year. Nigeria should be selling a bit more into Europe. So these are going to be some important things to watch on the physical market front, as obviously the paper market prices in an invasion. When you look at China's supertanker crude imports, you can see that there's been a steady increase. One of the things that we also want to touch on is, as we talked about with Iran. So there's a view that, Iran could come back. To be fair, they're already exporting a decent amount into the market, and there's a certain amount that the U.S. kind of turns a blind eye to. And it's going into India and China. So obviously it's going through those two entities under a different flag. A lot of that ship-to-ship transfer in Malaysia. But that's also one of the reasons why we're seeing some slowdowns out of West Africa, because you can buy a fully priced Angolan cargo, or you can buy a discounted Iranian cargo. And when you look at what China is looking to do, do they really care about sanctions against Iran? Not particularly. And they'd be happy to go out and get a discounted barrel, coming back to China picking up some more Urals, which then will kind of adjust the landscape on the physical side. So even though we're seeing an increase in Chinese crude imports, it's not driving anything lower in West Africa, which is to us indicative of additional flows coming from the Middle East, especially from Iran. Now, when you turn to the U.S., the workplace mobility, I think, is important to look at. There's a lot of that have been blamed on Omicron. The view is that as we get into March, you'll see a lot of that adjust. I'm giving a presentation tomorrow that's looking at just where things are and how comfortable some people are when you're looking about working from home. And I think you're starting to see a bit more of that adoption. And I think not really obviously right now or in March really, but as we look at May, June, July, I think we're going to see how much are people going to not be able to blame COVID anymore. And how much is that going to be more of a permanent thing? Because we've been saying that we expect about 5 to 10% pretty much consistently working from home or some sort of flexible schedule. And I should say 5 to 10% reduction in workplace mobility as more work from home and flexible schedules. So again, that ebb and flow in terms of when people stay home. Now, when you look at pricing, so here's just looking at the natural gas storage. You can see we're below that 15-year average. We're trending fairly low. Things are starting to warm up a bit. So again, it's not to say that we're not going to continue to draw. It's just the pace of draws will adjust. But you can see that we have some support between $3.50 and $4 gas, and when you look at it, $93 oil, above $3.50 natural gas, and above $30 on the NGL frac spread. And again, frac spread is two different things. So when we talk about frac spread in shale, we're talking about the actual fracture of the rock. When we talk about fracking or the frac spread, when we talk about NGLs, we're talking about the actual cracking of that those pieces into ethane, propane, butane, isobutane. So again, another thing that is going to be supportive of activity in the U.S., fairly low storage, again, within a seasonal range. Then we still have a record amount of LNG exports, something that we're going to cover next week. And then when you look at what's happening at the frac spread side, here you can see we're right back to the 2018 highs. We're over $30 for the NGL frac spread, which is obviously going to be beneficial if you're looking at how liquids are being priced and moved into the market. Now, after seeing some sizable increases in storage, we've had some draws. When we look at Singapore, you've had some pull down in light and resid. Those are things that, again, we think will bounce. But the one that we were expecting to stay fairly close to flat was the middle distillate. That, as you can see, had another big drawdown. And one of the things that we were seeing was an avoidance of middle distillate and an increase in demand for the residual fuel side, or that conversion from ultra low sulfur diesel to high sulfur diesel and the heavier cut. So that's why we expected that drop in resid, but that drop in middle distillate was something that caught us a bit by surprise and is a bullish backdrop. Now, when you look at Europe, you can see Europe, small drawdown in gasoline. Again, we expect gasoline to continue to build, and then a small build in gas oil, but still at a very bullish spot. Now, the fuel oil drop down is similar to what we were expecting with the residual side in Singapore. That arb has blown wide open given where gas oil is, ultra low sulfur diesel, very low sulfur diesel versus high sulfur. So we expect fuel oil to continue to move out and move into the system. But resid in Singapore still remains near all-time highs. Light distillate, again, same thing, with the middle distillate cut being the biggest piece. Now, as we turn to the U.S. inflation, we are running at over 7%. So we're now at 7.5%, 6% core. Blew through estimates. Some of the things that we like to talk about are the different backdrops of what is driving it, because you have sticky inflation, flexible inflation. You have reopening inflation and then non-reopening inflation. So there are pieces we want to look at because one's going to make this last longer than others. So when we look first at the contribution of reopening, so the issues, non-reopening components contributed 4.2%. So those are things that are away from the COVID situation, and then reopening was at 1.6%. So there's still some inflation on the reopening side, but you're just not. A lot of this is coming into the non-reopening, and you're seeing this steady increase across the board. When you're looking at the sticky side and away from the flexible inflation, again, giving way to where, if you remember, we thought that January was going to be a fairly flat period of inflation, but there was a surge in literally everything from that makes up the increase in inflation, which again is why we underestimated where inflation was going to be in January. But we do think that you'll get a little bit of a slowdown on the rate of change in Feb before we get that increase in wages going into March, into probably May or June. Now, when you look at the different backdrops, again, just gives you an idea of a flexible versus sticky. The flexible is really starting to it accelerated again. That's something that we think rolls over and cools off a touch. Again, still staying high, just not to the same level, where we do think that that sticky component, that less energy side, continues to grind higher on the back of rent, on wages, and a lot of these things that are just, again, going to have to keep up. And we're going to talk about why in a minute. And then obviously we have the food component, which is back to levels that we saw in the early 1980s. And unfortunately, it's going in the wrong direction versus where it was in the 80s and 70s. So here you see the movement going up. This is not something we think stops. I think the WASD numbers gave us more confidence that we are very right on where the price of food is going, and how this is going to become a bit of a sticking point when you look at the increase in underlying inflation. Now, when you look at the percentage of all CPI components, out of 250% growing plus or growing at 2% year over year. So that's about 87% of the components are growing at over 2%. Just to give you an idea of just how aggressive this move is. And even if you get some of these cooling off and slowing down, which is likely, you're still at a very elevated spot, which is why we talk so much about Treasury rates, what the Fed is going to do, and we think that there's going to be that continuous move higher on the rate side, which again puts pressure even more on the emerging market front. So this is just historically looking at core goods minus core services and the underlying inflation, and this is looking at with recessions. So the spread is more negative now than at any point going back to the late 1950s. So again, just more issues when you're looking at or really where core goods minus core services. So we do think that some of the services price are going to come back up, and you're going to start to see some of this closeout where the goods rolls over, services continues, and you see some of this collapse. But you can see that every time this has really happened, we've been in a recessionary backdrop. So again, just giving you an idea of where we are late, early, mid-cycle, if you will. So then when you look at wage growth tracker by occupation, so somebody brought up a good point on Twitter, and I kind of dug into this, and I like their viewpoint on wage growth tracker, not by the price of which or the type of job, but the skill level, because low skill is going to stay low skill, where you could go from low wage to medium wage if you break out, and that can skew some of the numbers. So I thought this was an interesting way. Again, there's value in both numbers. I'm not saying one is better than the other. They're just showing a bit more. This is showing a bit more consistency. So you can see that their wage growth is starting to pick back up, but you actually had a low skill drop. And that's the concerning thing, because now you have inflation going parabolic. We see the wages not keeping pace at all, and we'll talk about real wages in a minute. But here's, again, that spending thing that we look at going into the summer months. So if you go into vacation season and you have wages that are weakening, you have, or at least not keeping pace. And if you think about 2021, there were a lot of deals to go away. There were discounts. There were, stay 3 nights, get 1 free. A lot of those things are now gone. And so how much of that travel is going to be impacted based on some of these components? And it's not all equal. And where is inflation the highest? There's always places where New York is always known, and the tri-state area, and New England is always known for having a very high cost of living. So again, the rate of change is not going to be as aggressive on the coastal sides, but you can see in places that normally have fairly good living expenses are seeing the biggest increase in just the underlying cost of living. And I think that's going to hit people differently, and that's going to, again, drive some of the impacts that we're going to see on spending. Now, looking at wages, just again, rounding it out here, you can see the big miss in terms of real wages, where when you look at U.S. real average hourly earnings, we're at negative 1.7. And then when you look at real average weekly earnings, was at negative 3.1. So again, you're moving in the wrong direction because wages are still just not keeping up, which is something that is going to have to adjust or will adjust, which again is going to put some of that pressure on the inflation front. And just looking at this going back through 2007, Real average weekly earnings were down 3.1% in January, which was down from negative 2% in December. So again, you're seeing that for all of 2021, for the most part, we were negative, and now we're seeing that accelerate to the downside, even though wages are going up. Wages are absolutely going up right now. It's just inflation is going up faster. So inflation will start to balance out and wages will catch up. But even as inflation slows, it's not coming down. So again, the cost of living is still moving higher. So then when you look at how this is impacting University of Michigan, consumer sentiment is at the lowest it's been since 2011, where we've now taken out the lows from COVID. And then the underlying expectations, same thing. Again, a lot of pressure on the consumer and fears around where a lot of this is going to go in the near term. So some of the things that have always been discussed are price controls. And there's two very big periods of when we had price controls in World War II in the 1970s. And to be clear, they are vastly different in reasons. So if you think about the 1940s, especially the early 1940s, we were at war. The economy was operating in total war mentality, where everything was being pushed into the war effort. So people were willing to take sacrifices in the near term to declare victory and support our boys abroad. And again, those are things where it was very different. And just another anecdotal story, my grandfather was the foreman at Sugar Foods, based out of Long Island City during that time period. And he talks about how if there was one cracked cracker, if there was one biscuit that was wrong, if there was, a piece of butter that wasn't perfect, it didn't get sent to the boys. And that was what it stayed home because they only got the perfect stuff because they were fighting for our freedoms, for whatever, use your mantra that you want. So there was a huge amount of buy-in on that. The 1970s did not have that kind of buy-in, and you can see how the failures of price controls were. And now take it through history, price controls have always failed to really drive any type of adjustment in inflation outside of extreme war. So then when you look at, where things are, some of the other pressure points that we're seeing, emerging markets are under pressure. They're unable to cut the subsidies that they have for diesel and gasoline, which is putting more pressure on their currencies, putting more pressure on their policies and debt. And we're going to continue to see a lot of those struggles as many countries have started to confirm that they will not, mark to market against the crude price for fear of inflationary pressures that are going to hit their country. Again, putting more pressure on the emerging market world. Things that we've been highlighting for months now. So that's what we have for you today. I know there's a lot. We're going to cover more next week, obviously, in terms of EIA, Econ, and then the Frac Spread Show. But if you have any questions ahead of time, you can find us obviously in the comments section as well as on Twitter. So we hope you have a great weekend, and thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.